Testing, testing. 1, 2, 3. How about that? Put a 1 in the chat if you guys can hear me now. Looks like it's on. Let me see here. All right, you can hear now? Great. All right, let's go ahead and get restarted here. Welcome to the daily macro update for August 8th. Taking a look at this chart right here. This shows cash management bills versus the S&P 500. And for those who don't know what a cash management bill is, these are short-term bills that have a variable maturity date, right? So these are set by the government that have different maturity dates based off of the cash that they need. And so you can think of this almost like emergency liquidity, right? This is when the Treasury needs some short-term cash in order to fund something. And this has quite the rollover risk. And, what's interesting is that obviously these have been used more since rates have been accelerating, but really when they really started accelerating was all the way back here during summer of 2023. And it ramped up into 2024, and then it had a large drop off here. Now I also have the S&P 500 in red just to show some correlation. And it's interesting is that, when the government started just supplying this emergency funding, the markets have been doing pretty well. When it had a huge drop off, that interestingly coincided with the large sell-off that we saw in the S&P 500 back in April of this year. And so this is one thing that I'm tracking because as rollover risk becomes more apparent, this type of thing is going to cause rates to remain higher, right? And this is essentially what's also keeping inflation higher. So CMBs, I don't really hear too many people talking about this, but just emergency cash is reaccelerating here. As we just saw the most recent quarterly refinancing announcement by the Treasury Department, they are bringing these back. So emergency liquidity is back here. All right. Let's go ahead and take a look at something else that I want to look at, which is the title of this video here, which is that consumer credit is looking like it's being crunched right now. All right. So let's take a look at this chart here. This shows, because yesterday we got these numbers, consumer credit, right? And this is dividing it up between revolving versus non-revolving credit. An example of revolving credit would be something like your credit cards, where it's a continuous stream of credit. As you pay it off, you can respend it. And then non-revolving credit are things like a fixed loan, like student loans, auto loans, a home mortgage, those types of things, right? And so what's interesting is that when you take a look at the relationship of these things, you get quite an interesting relationship here. And typically, whenever you see these two things decelerating at the same time, that is not a great environment, especially for the aggregate economy here. And so, hold on one second, just fixing the camera. And so in taking a look at this right now, we have revolving consumer credit. The year-over-year rate of change is at negative 2.5%, which is, back-to-back both in May and June. But the last time we saw this was back in April of 2021. But when it was decelerating, that was all the way back in March of 2020. And so what this is saying is that the consumer demand is dropping considerably. And you're also seeing a drop in non-revolving consumer credit, which is heavily reliant on interest rates, right? And so if you do see interest rates drop in the context of a soft landing, you could see this metric go up, which it did a little bit here. But if these two start to really decelerate negatively, I mean, that's a clear sign that things are weakening at a faster pace. And so, I think that watching these consumer credit trends will give you a more clear look of how the actual consumer is doing in the United States. And yeah, you're clearly seeing a large deceleration right now. Typically, when these are both on the upswing, like we saw. Oops, let me go back. We can even go back even farther. When these are all the recessions going all the way back to the 1990s recession, and as you can see, again, when these two are typically non-revolving credit leads, but in this case, what's interesting is that revolving credit is leading. But when these two are decelerating at the same time, that's a clear sign that we're either in recession, heading into one, or we're going into some type of major slowdown. And so, yeah, seeing that we've pretty much been doing that over the past few years. Obviously, the market has done nothing but go up, but this is just showing how the underlying is still deteriorating here. The biggest booms are when credit is starting to come back, and yeah, we're not seeing that upswing just yet here. So, this just further shows that underneath all of the manipulation by the fiscal spending that's going on right now is a very weak economy, which I'm sure all of you guys already know that. But it's always good to see the actual data here. All right. Let's take a look at the market here. We got the dollar, in a neutral trend here, neutral in our model. Interestingly, after a crazy whipsaw, we'll see if this continues higher. I mean, still is a positive rate of change from the previous 6 months here. Let's go ahead and take a look at the S&P 500. All right, so it's about midday here. S&P 500 about to close new all-time highs here, which is interesting. The previous all-time high was back here on July 25th, and so we're pushing an all-time highs. Great time to take some off the table. If we take a look at the ranges here, we're getting right up to the top end of the trading range. And so this is just a good time to take profits on a lot of things that probably made you money this week, right? Don't be greedy, be incremental. Whenever our process says to sell something, we're not completely liquidating everything and going into cash. That's not how you do this. That's not how you do life, right? If you're trying to get healthier by going into the gym, you have to chip away at it every single day, consistently, incrementally for months. Same thing when it comes to your portfolio and keeping the compounding effect intact while also keeping in mind that you want to protect yourself to the downside, right? So yeah, pay yourself a little bit. Good job. You made some correct decisions. We're at the top end of the trading range. Don't be greedy. Sell some. There are some other opportunities that are going to probably come up next week. And so, yeah, just keep cash, keep giving yourself opportunities to buy at the low end of the trading range. And we're really just in an environment right now that is really good for trading. So for those who keep on trading, make sure you are, just practicing extreme discipline there. Volatility just keeps on coming down. I mean, you had that one spike in volatility at the end of last week. We are buying into that. And so, yeah, again, if you were buying into that, you had a great week this week. Now, someone was sending me a DM that, rates are going to come flying down from here. But when you take a look at the 10-year U.S. government bond yield, it's within the bounce of our stagflation ping pong that we've been talking about, right? So I'll just go on my X account here, Twitter. Where is it here? Okay, here we go. So when taking a look at the stagflationary ping pong, this was from a couple days ago. Pretty much since November, this has been, accelerating once it hits around 4.2% on the 10-year. And then once it hits 4.5%, it comes down from either recession fears or the pseudo government yield curve control by them doing buybacks is doing. So, yeah, I mean, that's pretty much what we've been covering, and not surprising, it's now back up at almost 4.3%. So we're just going to keep flip-flopping around here because now the bond market is starting to remember that inflation is not going away. In fact, when we take a look at the Cleveland Fed's inflation nowcast, look at core CPI remaining at 3%. That's not 2%. 2% is the pre-pandemic average for core CPI. That's the Fed's target rate, and we are well above that. So, yeah, inflation, if it's not trending down, the Fed is going to be reluctant to cut aggressively. Even if they do cut by 25 basis points in the September meeting, it's not, maybe they cut by 25 basis points and then pause again for a while, right? We'll see what happens from there. But, oops, that's not what I wanted. Let's see. Here we go. Yeah, so that's still around an 89% chance that they're going to pause. That they're going to cut by 25 basis points in the September 17th meeting. But just keep in mind, we still have 2 inflation prints, right? Next week we have CPI. I believe that's coming out. Let me see what day that is. That's on Tuesday. I would not be surprised if this comes in a little bit softer, just by looking at the price of oil, right? So if we take a look at the price of oil, that has cooled off quite a bit since July, or since June rather. So this move will probably be reflected in the CPI print that comes out next week. And so what you actually might see is some good news on inflation headlines, right? So remember what I'm saying right now. We'll get better than expected inflation numbers, meaning that it might be not coming down a lot, but less than what is being projected. Where'd it go? Here we go. And so, that has it coming in at 2.72%. I wouldn't be surprised if it comes in a little bit slower than that as well. So that would obviously get a lot of people riled up. You'll probably see some tweets from Trump saying like, hey, look, Jerome Powell, inflation's coming down. Then Jerome Powell will get on TV and say, okay, that's 1 month. We need to see, at least a couple more months of progress on inflation towards our 2% goal before we can really start a soft landing narrative from our messaging, right? So, but after that, after this next CPI, the August print, which gets reported in September, right before the meeting, that has it reaccelerating to 2.9%, 2.86, but it'll be shown as 2.9. So we're at 2.8. We go down to 2.7. Yay! And then it ramps right back up to 2.9. Oh no! See the whips in inflation readings that we're about to get? Just keep that in mind. With that being said, though, you could see a nice little pump next week continuing in the market expectations of inflation maybe coming down more, which could happen if we really start to see a crazy slowdown. Who knows? But as of right now, that's what I'm seeing in the markets here. And that's also why you're seeing a little bit of an increase from the other day. Yesterday, there was an 8% chance of a pause, and that ramped up to 10%. So, we'll see that, I believe, continue to normalize from now until the September meeting. Maybe this won't be at 89% by the time we get close to the meeting. Maybe this will be closer to like a 60-40 split. So we'll see what happens from there. Not only that, though, If we take a look at the 5-year break-even inflation rate, look what happened throughout July. This came down, and now it's starting to pop back up again. And then if you really want to zoom out, going all the way back to September, here is what inflation expectations have been doing. So let me see if I can find an arrow. Yeah, there's your inflation expectations. So, yeah. Don't ignore inflation. Don't ignore it. But lastly, we'll take a look at the 13-week Treasury bill, and this had a big drop off here, but it's not having a continued drop off. The reason why we want to pay attention to this is because, this time last year, this really started to decelerate throughout the month of August, which was a big confirmation that they were going to cut in September. And so with this ticker here, IRX.P, I'm looking for a large crash in this, which would showcase that the Fed is definitely going to cut rates. So you can put this on your ticker list, but that's one that I'm paying attention to as well. We got down to it briefly where it's at. I mean, this is the second lowest that it's been recently since, when prices crashed on April 4th. And so, yeah, this could be pricing in a 25 basis point cut here coming up in September. But again, if inflation continues to go up from here, then you're not going to be seeing a sustainable cut the next meeting. All right, let's get into some of the questions here. Appreciate everyone for joining a little bit early here today on a Friday. Let's see. Is MU at the top end of the trading range? Well, MU went bearish in our model, so but to answer your question, yes, this did pop up to the top end of the trading range here. Still is, well, actually it's trying to pop up to be, this is considered neutral still, but it's looking like it did go from bearish to neutral, so that is a positive rate of change. Cover ETH and Bitcoin dominance, please and thanks. Sure. Ethereum, simply at the top end of the trading range. So, our model right now would say to sell some, but, Ethereum remains in a clear bullish trend. But it's at the top end of the trading range. So pay yourself a little bit. And then Bitcoin dominance continues to be in a bearish trend. So alt season is still here for select DeFi tokens. All right. Now, if you guys see how I'm using this trading range model, if you guys would like this indicator for yourself so that you can bring it up on any type of ticker that you want at any time of the day, and you don't have to wait for you to ask a question on these daily live streams. You can have access to this trading range model if you're part of our partnership circle. So if you guys are interested in that, just shoot me a DM, or you can go on our website, macro-optics.com, and you can book a call with me, and we can talk about it a little bit more of what that entails. But that's pretty much all I have for you guys here. I mean, this was a quiet week this week in terms of macro data. Really, the only thing that we had was the ISM Services PMI, as well as the 10-year and 30-year bond auction, as well as consumer credit. But that was really it. Pretty quiet week here, which, we were talking about last week could have been, a decent week. So next week, not so much of a quiet week, as we have Cleveland Fed expectations for inflation, NFIB small business indices, CPI, PPI, core retail sales, as well as University of Michigan sentiment surveys. So all of those are coming out next week. But yeah, that's pretty much all I have for you guys here today. I appreciate everyone for joining. Have a great weekend, and make sure to catch us on our next live stream, which will be on Sunday for our Sunday macro wrap up. That will start at 8 p.m. Eastern time, right here on the channel. So have a great weekend, everyone. And yeah, we'll see you on Sunday. Bye.